Good evening, family. Welcome to the fifth installment of the Wealthy Wallet Wall Street course. Please do not forget to hit that subscribe, like, or follow button if you find this content to be very valuable to you. But I don't want to keep you long. We're going to go ahead and dig right into it. I hope you, if you forgot some things of last week, you're probably going to have to go back and listen because this ties right into everything that we taught, everything that we learned last week. And there's going to be a lot of things that we learned last week that is going to be in this week's course. So in this week's class. So please, if you have to go back to next week and listen to it all over again in order so you can be caught up with this one, so that you can completely understand what we're talking about, then jump right over and listen to that first before you listen to this, because you're going to have to understand last week's class before you can completely understand this week's class. But let's jump right into it. We're going to talk today. We want to start off with it's called the moving average convergence divergence. What is the moving average convergence divergence? The moving average convergence divergence, aka the MACD, is what us traders call it. We call it the MACD. The MACD is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. So, in other words, the MACD helps you to understand a trend's momentum by using its apparatus, its indicators, an instrument that is used to show you the two moving averages between a stock's price. So what this tells us is it gives us a 9-day EMA, which I told you we learned what the EMA was last week. An EMA is an exponential moving average, and the exponential moving average of the MACD, called the signal line, triggers technical signals when it crosses above to buy or below to sell. So in other words, this technical or this instrument or this indicator or this apparatus tells us that when it crosses a certain point or a certain line, it gives us a buy signal, or when it crosses below a certain point, it gives us a sell signal. And the speed of that crossover is also taken as a signal of a market being overbought or oversold. So it not only tells us when we should buy a stock or when we should sell a stock, but it tells us whether a stock is being oversold or overbought. So remember, we learned last week that with the relative strength index, which is called the RSI, right? So if the RSI is telling you that the stock is being overbought, and then also the MACD is telling you that the stock is being overbought, so you got two indicators telling you the same thing, then you probably should jump out when it's overbought, because that means the stock is about to fall. Or when you got a stock being oversold, right? It tells you that the stock oversold. The MACD is telling you, the MACD gives you a signal line that tells you that the stock is being oversold, right? So if we know the stock is being oversold, we should probably jump in because that's at the bottom. And this selling, and they can't keep selling this stock for no reason. There's too many people selling it. It's being oversold. It shouldn't keep being. There shouldn't keep being a fire sale. The sale shouldn't keep on going on. So when I see the sell or it cools off, the selling pressure cools off, then I jump in there, right? I jump in there because at the end of the day, the MACD and RSI is telling me that this stock is being oversold. Too many people are selling it, right? So if too many people are selling it, and then when I find out that the selling pressure cools off, and I'm gonna show you how to find out when the selling pressure cools off too, so that you'll know when to jump in, right? So, and the MACD also helps us to understand whether the bullish or the bearish movement in the price is strengthening or weakening. But what's all this talk about signal lines and EMA and the MACD line? Well, I actually have to show you exactly what I'm talking about. So right here is the MACD line, and this is an actual stock that I traded throughout the last 2 days. So I want you to pay real close attention. So down here at the bottom is the MACD. This is the MACD, these lines. And the MACD is made up of four components, right? The MACD line, this blue line is the MACD line. The MACD line is made up of the MACD line is made up of a 12-day moving average and a 26-day moving average. And you subtract the 12-day moving average, the 26-day moving average from the 12-day moving average. And this is how you get the MACD line. And remember, we talked about moving average last week. So if you missed last week's course, then you need to go back and watch what we talked about when we start talking about the first indicator, which was a moving average. And we talked about what a moving average was. So if you need to have explained to you what a moving average is, please go listen to last week's class again. But the MACD line right here is made up of a 26-day average and a 12-day moving average subtracted. So if I subtract the 26-day moving average from a 12-day moving average, it gives me the MACD line. And then the smoother line, you see this line is more choppier. The MACD line is more choppier, right? There's a lot more curves to it. And then you have the signal line. This is the signal line. The signal line is made up of a 9-day moving average of the MACD. So whatever the moving day average of this, it takes 9 days from the MACD line and it creates the signal line. That's why you see them, they follow very similar, because this line is a byproduct of this line. But this one is based upon a 9-day moving average. So we have here again, the MACD line is made up of a 26 minus a 12-day moving average, right? And then the signal line, right? The thicker light blue line, the MACD line, and the yellowish line is the signal line. And I'm gonna explain why it's called the signal line and why this one's, and then we just explained why this was the MACD line. See, the signal line is made up of a 9-day moving average. You see that when the MACD crosses the signal line, the MACD crosses over the signal line, look what happens to the stock. Just take a look at the stock. The stock was shooting up, right? And the stock was shooting up. Remember, we talked about candlesticks, so I hope you learned all your candlesticks, right? The stock starts shooting up, boom. And the MACD shuts. Look, the MACD is shooting right up with it. Okay, but the stock shot up its farther. It's not going any farther. And then boom, look at this candlestick. Look at the selling pressure. Man, there's so many sailors in this candlesticks. So, and what is the MACD indicating to you? Oh man, this is about to be on a downtrend. So look, but we keep going, right? You see this little candlestick right here in the middle. You see this one right here in the middle, right? It's tried to shoot back up. Then we see this one, it turned green, boom. But look what the MACD is doing. The MACD is not really moving. So it tells us, right? It tells us one thing, that the stock is not going up. The stock is trying to go down. So the stock is about to be on a reversal pattern. You see it, you can kind of see that it was on an uptrend for a little bit. But the MACD is telling us, no, this thing is about to go on a downtrend, right? And how do I know that the MACD is telling me this is about to go on a downtrend? Remember, we talked about the signal line? And the moment you see the MACD crosses the signal line, look what happened. The MACD crosses the signal line. And as soon as the MACD crosses the signal line, look what else happened. The stock started to jump out the window. The stock started to jump out the window. Look, the stock jumped straight out the window. Let me move me real quick. Let's see. Since the stock jumped out the window, it was at $38, right? At its height. $38 at its height. 30, if you watch up here with the $38 at its height, right? And then the MACD crossed over, and then this thing began to cross over. Boom, let's see, about right here. This is where it crossed over at 37. So it's dropped 80 cents. It dropped 80 cents and the MACD crossed over the signal line. And then immediately, as soon as the MACD crossed over the signal line, that's an indication that it's time to sell. It's not time, you should no longer stay in. You got to punch out because the stock is about to be on a downtrend. So the moment the MACD line, right, which is made up of a 26-day moving average and a 12-day move and a minus a 12-day moving average, when it crosses, right, the signal line, right, which it crosses the 9-day moving average line, that tells you it's time to sell a stock because the stock is about to be on a reversal downtrend, right? And then the MACD is also made up of two other components. It's called, you see this purple line? It's called a zero line. You call this the zero line. Usually when a stock is above the zero line, that means that when the stock is above the zero, when the MACD and the signal line, is above the zero line, that shows us that the stock is bullish, right? It's on an uptrend. It shows us the stock is strong bullish because it's above the MACD line. And when a stock's MACD line and the signal line is below the zero line, it shows us that the stock is on a downtrend. It's on a bearish trend, right? It's the bears got a hold of this. But when it's above the MACD zero line, it shows us that the bulls have a hold of it. So above, the bulls have a hold, below, the bears have a hold of it. Bullish, when it's above the zero, above the purple line, right, which is the zero line, when it's above the zero line, it helps us to understand that it's in an upward trend or a bullish market, right? And when it's below the zero line, it helps us to understand that it's in a bearish trend or a downtrend in a bearish market. So this is another powerful thing about the MACD indicator. And then there's one more other thing that the MACD indicator is made up. It's called a histogram. Okay, what is a histogram? Let's define what is a histogram. A histogram is a geographical representation that organizes a group of data points into user-specific ranges. It is similar in appearance to a bar graph. The histogram condenses a data series into an easily interpreted visual by taking many data points and grouping them into logical ranges or bins, right? So what do you mean? So you look right here, you see these red, I just showed the purple line is the zero line. And then we have these red bars, and then you have these green bars, right? These are called histograms. The histograms are made up of data. What data is this histogram made up? It's made up of the exponential moving averages of the MACD lines, right? It's taking the data from these lines and putting it into bar form. So, right? So it tells me right here in bar form, let's start right here. It tells me right here that the buyers, the bulls, have control of the stock. And then you see the bar gets higher, right? So it also tells me that the buyers are strengthening, that the stock is becoming more bullish, right? Because more buyers are jumping in. And then you see the bar goes up even more, right? Boom. So it tells me the buyers are strong on this stock. The buyers are going hard on this stock, right? Boom, another bar tells me, boom, the buyers ain't stopping. They ain't coming down, man. They coming out swinging, knocking the sellers out, right? This is what the bar chart is telling. This is what the histogram is telling me. It's telling me that the momentum is going upward, baby. It's not coming down, right? So, but then look at the next bar, though. Oh, hold on. The sellers wants control now. Look what happened. The data, the momentum, the volume, the hike in price, the 12-day moving, the 9-day moving average and the 26 minus 12-day moving average is declining. This is what this is telling us. It's declining. The bulls are cooling off. They ran out of gas, right? This is exactly what this is telling us. It's telling us, oh, hold on. The bulls are running out of gas. Otherwise, this will keep going green, right? Or it would stay green, or the bar could stay the same. They're keeping the same strength. But instead, look, the bar falls down. And look, the bar's falling down right here. So that means the buyers are losing all type of power, right? The buyers try to take a little swing and try to take another swing up, but the birds are not having it. The sailors are not having it, right? They want the stock to go down. And look, boom, it's not increasing. It's not going back up. So the MACD line is telling us it's swirly, but it's not going back up, right? So look what happens. Ooh, now look, the histogram goes to the red, to the sailors. The sailors have hold of the stock now. And the sailors' pressure is increasing, right? The data, the MACD says the sailors and the momentum of the sailors are increasing. It tells me that this stock is in a downtrend, right? The stock is in a downtrend. And the closer these lines are to each other, then I know it's about to be a crossover. But the farther these lines are away from each other, that means I know it's going to stay in a trend. But the closer they are to each other, I know that there's going to be a reversal. Look, it gets, look at this. These parts get real close. Circle around here. Look how close this gets. When it's this close, I know there's going to be a reversal, right? When I look at the histogram and I start seeing this, there's about to be a reversal. But when I see that, look how far they're apart. Boom, look how far this apart. The stock is just on an uptrend, baby. It's gone. It's gone. It's gone, right? It was gone right here, right? But when I know this was close, I knew, again, it was about to be a reversal. So I can automatically tell a reversal is about to happen. It goes from red to green. I know a crossover is about to happen. And when a crossover happens, right, when the stock crosses over and upward, right, it's time to jump in. When it crosses over downward, it's time to jump out. This is why this is a signal line. The signal line is trying to express to you that the stock is either about to go up or it's about to go down. So you jump in right here. You see it? You see the histogram saying, okay, the lines are about to cross because these things are very close, right? And the stock is about to be an uptrend because the moment it crosses the signal line, it's time to buy it because that means the stock has decided that it no longer wants to continue to go down or drop in price. So right here, guess what I do? I buy the stock. And then guess what? I'm gonna ride the momentum. Look, the momentum. I'm gonna ride it. I'm gonna ride it. I'm gonna ride it. You know, and if I got 20 contracts, right? This and I wrote this. I literally made like 2 grand off riding this from 35. I mean, from 37. I mean, $36 to 37 all day. Like boom, I ride it. I buy it when the MACD says to buy it, and I sell it when it's about to go right. When it's about to cross over to the signal line, sell it again. Made $300 or $400. Boom, and continue to rinse and repeat. Right? You continue. You can do this all day. You could literally do this every single day, all day, and there's no excuse or reason why you can't make 2 or 3 grand a day just trading stocks. I mean, of course things happen because you can't watch every single stock just like this, right? That's why stop losses are available. But if I were to focus on one stock and it has a volatile personality, because there's some stock that do not have a volatile personality, meaning they just flat. They just stay in one line. They just stay in a trading chart. They don't go farther down. They don't go a dollar down. They don't go a dollar up. They just stay between a 5 to 10 cent range. And you ain't gonna make no money off that, right? We need stocks to go up five, to go down $2, they go back up $3. Stocks that do that all day, woo, I love those. Those stocks make me plenty of money because I jump in and I jump out. And you can only do this when you actually a day trader. And a day and in order to become a day trader, you have to have $25,000 or more in your account on the closing previous day in order to be a day trader. But we're going to express that in a later time. I'm going to show you the difference between a swing trader and a day trader, because I want to teach most of you all to become a swing trader, so that way you could build up a $25,000 account. Uh, I'm in my when I first started, I started with a $526 account. Don't ask me why it's that much money. That's just exactly how much money I was able to transfer from my bank account at the time when I started jumping into stocks. And I did a lot of studying and paper trading in order to get that to over $25,000. And it took like six to 7 months. But in the 6 to 7 months, I learned a lot of lessons. I mean, I hit 25,000 one time, within like 3 or 4 month period, and I lost almost all of it on an Amazon play because I wasn't that very smart. I started trading options and I knew very little about options, and losing $22,000 taught me a very expensive lesson. So I definitely learned uh, a very expensive lesson, but I'm glad that happened. I wouldn't take it back because it made me a better trader. And because if I had gave up then, I wouldn't have got that same $3,000 back to over 100,000. But but it is what it is. So let's continue to look at this. But and I know that when the stock is about to be on a reversal, look, it's going down. Look, boom, it crosses over the signal line, right? And remember again, the farther away the histogram, the seller's histogram, and then the buyer's histogram are from each other, the stronger the trend is. So I see this is on a strong downtrend, right? Because look, right here it was on a strong bull trend, right? It was on a strong uptrend. And then down here it became a strong downtrend. And look, it did not stop. There was no cooling off. The baby did not stop. It just kept going and down and down and down and down and down. So this shows me that the buyers got hijacked. There was no more for the buyers. The sailors took completely over. And this is what the MACD helps us to understand. It helps us to understand buy points, sell points, buy point, sell point, buy point, right? Because look, it started to cross over a little bit. This would be my buy point right here, right? Ride it up a little bit. Oh, it's about to cross over again. Let me sell it, stop, right? Boom, let me get out, right? And then it just stays flat most of the day, right? This is exactly what it did. Stay flat. And went into after hours and basically stayed flat. Didn't do anything else. But the MACD is a very powerful indicator because it definitely teaches what I just showed you. But let's move on to the next indicator. So what do we have next? Oh yeah. Before we move on to the next one, I do want to explain the difference between the RSI, which we learned about last week, and the MACD. The MACD measures the relationship between the two MAs, which I showed you, right? While the RSI measures price changes in relation to recent price highs and lows, right? And we learned that last week. These two indicators are often used together to provide analysts a more complete technical picture of a market. And like I said, when both things saying to you that the stock is being oversold, probably should jump in when the buying pressure cools off. And we understand how to understand when the buying pressure cools off. Look, boom, look right here. You see, look, the selling pressure is starting to cool off. Look, it's cooling off. So that means it's time to jump in because I see a green bar now. So I don't jump in right here because I don't know what's going to happen when it crosses over, right? I'm going to jump in about right here because I know that the selling pressure has cooled off. So now it's time for the buyers to take over. And the buyers tried, but the sailors were not having it. And look, the buying pressure cooled off. And then it stayed completely flat, right? Right here, you see the brine, the stock is being oversold. You see, it still hasn't cooled off. It's still going, still going, still going. And then right here, the selling pressure cooled off. So that means when I see the first green histogram bar, I'm gonna jump in because I know this data represent a lot of buyers buying to increase the price of the stock so that I may get in and ride the stock up and make my money and make my coins, right? All right. So, but let's move back over to the next. Okay. Let's talk about VWAP. What is VWAP? VWAP is the volume weighted average price. VWAP it stands for the value weighted average price. The value weighted average price, aka VWAP, is a trading benchmark used by traders that gives the average price a security has traded at throughout the day based on both value and price. It is important because it provides traders with insight into both the trend and value of a security, right? A VWAP ratio will help you move into or out of a stock with a small of a market impact as possible. Therefore, when possible, you need to always try to buy below the VWAP or sell above it. This way, your actions push the price back toward the average instead of away from it. VWAP can also be used as a trend confirmation tool and build trading rules around it. For example, when the price is above VWAP, you may prefer to initiate long positions. Long positions mean you're buying a stock hoping that it's going to go up. A short position is when you buy a stock hoping that it's going to go down. Long position, when you buy a stock, that means you have a bullish thesis on it. And then when you short a stock, that means you have a bearish thesis on it. So when the price is above VWAP, you may prefer to initiate a short position, meaning that you're gonna bet that the stock you bet that the stock is going to go down, and you make money when the stock's going to go down. But we're gonna learn that in a far later class on how to short stocks. That way you make money going up and you make money when it goes down. But I'll have to teach y'all that later because you have to first understand what a short position is. Okay, let's get into a real life example of VWAP on a real chart. This is VWAP on a real chart this is on my chart that I use to trade all the time, right? So let's see here. This line is the VWAP. You see this curvy line, this light blue line that goes curvy according to the stock of the price, right? Boom, up and then down. This is the VWAP, right? So, so what does the VWAP tells us, right? The VWAP displays a bullish sentiment when the price is above the VWAP and a bearish sentiment when the price is below the VWAP. The VWAP is basically, it sums up the price and the value based upon this line. So this line is made up of price and volume, right? Price and momentum, price and the value going in and out, right? Okay, so let's say so the VWAP takes into account how many shares were traded at a specific price. So if the VWAP takes into account of how many shares were traded at a specific price, so when you see a VWAP line, it tells you that if the price is higher but the VWAP is lower, that the price is trading higher than the average price, right? So what do you mean, Donnie? Let's take a look right here. Boom, let's look right here, right? So when a VWAP, let's wait till it moves out. So the VWAP right here, right? The stock was trading at the average price of the stock is $35, right? The average. This the VWAP tells you the average price of the stock is 35, right? And look what the stock is doing, right? It's trading below $35. Matter of fact, it got to one point at 34.80, right? First at VWAP, it was trading at 35.56. It traded down almost a whole dollar, right? It traded down about 60 cents, right? About 70 cents. Came down about 70 cents at its lowest. So let's draw a support line right here. The support, remember we talked about resistance and support, right? Let's talk about it. And then I have to draw my resistance. Remember, just be sure, we'll go back 2 classes and you'll learn what resistance and report is, right? So this is my ceiling because it won't break above this, and this is this is my resistance, and this is my support. But all right, so let's go back to the VWAP. So a VWAP tells me right here, boom, the average price of the stock was trading at 35. You know, as time goes on, it's moving down, right? It's moving down because I want to pay close attention to the VWAP and average price until the VWAP actually levels out, right? To where it's just not a straight curve or a drop. I don't want to jump in when it's a straight curve or a drop. I want to wait till it like levels out, like right here. You see how it's kind of like levels out. So I will use something like this, right? I will use that the average price of the VWAP is $35, and then support is at 34.82, right? And I know, so the VWAP is telling me the average price right here is $35.19. And right here, I'm gonna jump in the stock at support, right? Right here, I'm gonna jump in, right? Boom. Tells me where to jump in at. So look, MACD tells me to jump in here, right? Pressure is increasing, so I jump in because I know I'm jumping in because I know that the average price of the stock should be $35.29. This is what the VWAP is telling me. So when it crosses over, I know, even though I know it's at $35, I mean, 35.03, right? 35.03, I know that the average price is 35.35. So I'm gonna jump in, right? Because the MACD is telling me it's time to jump back in because it crossed over. And also the VWAP is telling me that the stock is trading below its average price. So if the MACD is telling me to jump in because it just crossed over the signal line, and the VWAP is telling me that the stock is trading below its average price, then why would I not jump in this? Why would I not jump in this? All my signals is telling me jump in. It's trading. VWAP is telling me that it's trading below its average price, right? And MACD is telling me I just crossed over the signal line. I'm about to be back on an uptrend. And look what the stock ended up doing when you buy it down here, right? And at the end of the day, when it closed at 5 o'clock, 4 o'clock, 5 o'clock Eastern Standard Time and 8 o'clock Pacific Standard Time, the stock got back on an uptrend. Look what it did. It went above VWAP, right? It got above VWAP. And then look how the stock is starting to cross over. Like right here, it crossed over. MACD crossed over. So lets me know that the stock is about to be back on an uptrend. So VWAP basically just gives us the sentiment of the stock, whether the stock is going to be up or down. I know when the stock is above VWAP, then it gives me a bullish sentiment. When it's below VWAP, then I have a bearish sentiment, right? This shows me that the stock is about to be on a bearish trend when it's trading below VWAP. But when it's trading above VWAP, the volume average weighted price, right, shows me that the stock is on a bullish trend. But when it's below VWAP, the stock could possibly be on a bearish trend, right? But the VWAP helps me also to assess where I should jump in. So I know that when I want to trade the stock, I want to always jump in below VWAP. I don't want to jump in above VWAP. I want to jump in below VWAP. And the only how you can jump in below VWAP is when you read your other indicators. Remember, we talked about RSI between 30 and 70, right? If the RSI is over 70, and it's below VWAP, I still don't want to jump in. I want all my I need at least 4 indicators to give me that conviction. I need enough conviction for my indicators. So if I'm using 5 indicators and 3 out of the 5 say jump in, I'm jumping in. But if only 2 out of the 5 say jump in, I'm probably gonna wait on the sidelines because I try to lose as much money. I try to lose less money as possible, right? That's why I use 3 or more indicators. I use at least 5 indicators to tell me when to jump in the stock. Because if I use these indicators, then it helps me to make better decisions, right? What if you had things throughout your life to help you make better decisions that won't cost you a lot of time or a lot of money? So this is why I use these charts. They help me to use these indicators because they help me to make great decisions. And these great decisions always lead to profit. So that's why I'm always paying attention to each and every one of my indicators. So never try to jump in below VWAP. That's why you always should study a stock's behavior and know your entry and exit strategy before jumping in. So no, I'm jumping in below VWAP, right? I'm watching MACD, right? This is MACD right here, right? And it's trading below VWAP. So when it crosses over here, guess what? This is giving me a sell signal. It's below VWAP. The buyers are increasing. The MACD line has crossed over the signal line. Time to jump in. 3 indicators telling me jump in. So why would I not jump in, right? Why would I not jump in? It's not below support. It's not above resistance. So why would I not jump in this when everything's telling me to jump in? I'm jumping in because that's what it's telling me to do. Jump in. Now listen, buy below VWAP, sell above VWAP, right? Buy below VWAP, sell above VWAP when it begins to cross over, just like right here. You sell above VWAP, right? Boom. You see when it cross over right here? Look at this. VWAP's right here. It's about to cross over below its value weighted average price. About to cross over below VWAP. And look what it does. And look what the MACD does. So the MACD tells you it's time to sell, right? At this candlestick. I'm selling right here. I'm selling at this candlestick. I'm punching straight out. You know why? Because it just now crossed over below its VWAP. It just now crossed over on MACD, and the seller's pressure has increased. I got 3 things telling me that the stock is about to fall. It's time to exit because all my indicators are telling me it's time to exit. And when you don't listen to them, oh man, it could cost you a lot actually. So listen to your indicators. All right, let's move on to the last and final indicator. The last and final indicator. What is the last and final indicator? It's called Bollinger Bands. Bollinger Bands. What are Bollinger Bands? What is a Bollinger Band? A Bollinger Band is a technical analysis tool defined by a set of trend lines plotted with 2 standard deviations, positively and negatively, away from a simple moving average. SMA. Remember, again, if you don't know what a simple moving average is, please watch last week's video. And the simple moving average of a security's price. So it gives us a technical analysis chart that's plotted by 2 deviation lines, right? With a positive deviation line and a negative deviation line that either goes away or goes away from a simple moving average. So let me explain it to you, and what Bollinger Bands actually tells us. It helps us to identify entry and exit points as well as big moves that are about to happen. So let's look at it in real life. Okay, these here are Bollinger Bands. I know this chart looks a little messy, but this is how I trade every day. Right here is my green. This is the VWAP, what I use every day. But we're gonna focus right here on the purple looking lines, right? And we're gonna stand there. All right, so here we go. So Bollinger Bands have 3 type of deviations. The first deviation, which is a little smaller, like this will be the first type of deviation where you see these lines contract. They're contract a little smaller, right? That's deviation number 1, and only 68.2% of stocks stay within the first deviation range. So only 68% of price movement actually occur, right? So that means most 40% of the time it's always going to be out of this range. Deviation number 2 is when it expands a little bit more, right? And 95 point, I think 90, more than 95.9%, excuse me, of stocks stay within the deviation number two range, right? And then deviation number three is even farther, and 99.9% of all stocks stay within the third deviation. And most people only use two deviations, in which I have it on two deviations, right? Because 95.5% of all stocks stay within the two deviation range. But the Bollinger Bands will help us basically to trade the gap. Help us basically to trade the gap. Every stock has a specific pattern of behavior. Every stock's always fall into a certain gap. And what Bollinger Bands helps us to do is trade that gap. And you'll see right here, you see the gap, this gap from here to here. It helps us to be able to trade each gap. Boom, you see the south Bollinger Band and the north Bollinger Band, and then the mean, the average Bollinger Band, right? The one that's right in the middle. And that's what Bollinger Bands help us. Bollinger Bands will help us all. Bollinger Bands will expand and they will contract on as based upon the volatility that goes in the stock in the last 20 days. So like right here, we see there were very little volatility because all the value, all the traders said, hey man, it's time to check out, man. Had a good day. It's Friday. It's time to go. So basically there were very low trading value. And when there's very low trading value, it contracts, right? It contracts, it comes together. And then, so that means very little volumes going into it. That means it's going to have very little volatility because not many people's trading anymore. And then you see as it, when it has high volatility, then I know there's a lot of sellers and buyers in here. So remember, when it contracts, very little value, very little momentum could happen because there's not many people trading. And but when it expands, you see there's a lot of people trading. This is the volatility. It shows there's going to be a lot of volatility. So the farther these are from each other, the more volatility that is in the stock. The more volatility, the more action, the more momentum's going on. And then the smaller these lines are, the smaller these bands are, the less momentum that is going on, the less volatility. But we always want more volatility because again, more volatility, you get up and down prices. I mean, the stock can go from, from $37 all the way down to $34 or from $33 all the way back up to 38. We need that volatility because volatility raises prices up or down. So we understand that when the bands are far apart, it usually indicates that the bull or the bird are about to run to a certain end, right? So let's dig into how these Bollinger Bands actually work. All right, so usually, see, look, so right here, you see the Bollinger Band touch the bottom one, the south one. So usually people buy right here. I would have not bought any stock right here because look, it kept going down. I will wait till it gets green and it goes back over the Bollinger Band, right? And it holds the price for a couple seconds, right? It held price. So this is probably where I would have jumped in at, right? And then you ride it. It goes past the medium average price, right? And it tries to touch the north band, but it never made it there. It went back down. So I'm watching it. Oh man, is it gonna go past the medium one? It did. It did go past the medium one. However, it did not touch the bottom one. All right, so we good. We good. Then the next counter bar, it went back up. Right, it's trading within the median range. Oh, then now it shoots. And then since it shoots, I know, boom, it's time to sell right here. It touches the bar, right? Usually, I wait a second to see if it's going to go over this band. And once I see the price start to tick down, guess what? It's time to punch out because I know it's going either back to the mean, back to the middle, or it's going to touch the bottom band, right? It's going to the top band, it's going back to the middle band, or it's going to touch the bottom band. In this instance, I hope that I could have sold here, right? Punched out here, and waited till it got back into the bottom band and then punched back in on the bottom band, but it didn't get to the bottom band to right here, which is when you get back in, right? You get back in at the bottom band and boom, it gets to the middle band, but it don't touch. Boom, it don't touch again. It don't touch again. It don't touch again. Oh, guess what? It's time to punch out of this. It's time to punch out of this one. It's trading below VWAP. It's probably time to punch out because this thing is probably about to go on a downtrend because it never made it past the medium band, right? So boom, boom, and you see exactly what happened. So the volume's going down. All right. So there's five types of indications on these Bollinger Bands. One is the constriction indicator, right? This is the constriction, right? The constriction means no volatility, really no price movement. It's staying within its small flat range. That's the constriction part of the Bollinger Bands. And then you have the bullish expansion, which is right here. You see the bullish expansion. The bullish expansion happens when you see the stock, the gap widens, right? But the candlestick is touching the upper band. When the candlestick is touching, you see right here, when the candlesticks are touching the upper band and it continues to expand because more volatility is coming in, right? So it's expanding, but the candlesticks are touching the upper band. This is called a bullish expansion. So the Bollinger Band right here is indicating to me, after about 30 minutes of trading, that is going on a bullish expansion because, right, look, first it was contracted, right? It was constricted, and then it started to expand, and the candlesticks went upward, right? So if the candlesticks going upward, I know this is a bullish expansion on the Bollinger Bands, right? And then you have number three, what we call a bearish expansion. It's the same thing as a bullish expansion, but in reverse, right? So if I have a bearish expansion, then I know when the candlesticks are spreading, but the bands are expanding, but the candlesticks are touching the bottom. So if the Bollinger Bands are expanding and the candlesticks are touching the bottom, like right here, you see the candlesticks touching the bottom, then I understand this is a bearish expansion. The stock is going down, right? And then when you have and then number four is when you have a bullish move up. It's just like this. You see how they kind of contracted, right? And when they counter contracted, and then the candles, but they're very close in the candlesticks, and both the candlesticks and the Bollinger Bands are leaning upward, right? They're both going upward, right? Instead of one going downward and one going up, when there's a bullish expansion, but when there's a bullish move up, the candlesticks they're more concise, more condensed, and then the candlesticks are touching the upper part. And then number five is when they're doing the same thing, right? It's vice versa. When there's a bullish move down, right? The candlesticks condense, right? Just like it's condensing right here, right? You see it condensing right here. Let me see if I can draw here. Let's see. Drawing. I need to draw. Let's see if I can draw. I don't want to draw here. Y'all get the picture. I'm not going to draw. So, but when you see this right here, you see it has condensed, right? But it's touching the bottom. So I know that this stock is on a bearish move down, right? Condensed, but on a bearish move up, right? Candlesticks are touching. Look at the expansion, right? Expansion. I know this is on a bullish expansion. And I know this part of the Bollinger Band is on a bearish expansion. Look. So it's touching the candlesticks downwards, right? It's hitting number two deviation. This is a two deviation candlestick chart, right? So the Bollinger Bands is telling me that the stock is on a downtrend because the Bollinger Band is showing me that volatility is increasing, but it's not increasing in an upward trend. The volatility is increasing in a downward trend, right? That's what these Bollinger Bands are telling me. Right here, the Bollinger Bands is telling me that the volatility is increasing, but it's increasing in an upward trend. And then the volatility becomes more, but as it becomes more, it lets me know that more sellers are selling than buyers are buying. And when more sellers are selling than buyers are buying, then the expansion is going to be downward, not upward. So I understand that if the stock is going downward, right, I probably shouldn't jump in unless I'm shorting the stock. But again, we're going to talk about shorting stocks later. So now that I have literally all these indicators put on here for you, right? I have every single indicator on here for you, right? I have the RSI, right? I have the MACD. I have the volume because I definitely need to know volume, but we're going to talk about volume another time because I want to jump into with volume and candlesticks. I want to show you how to weigh out candlesticks and volume together. And then we have the Bollinger Bands, and then we have the VWAP. So we have all of these indicators together. So let's explain. So let's take a look at all these indicators, right? So boom, the market opens, right? Right here, the market opens. The market opens right here. So I see the stock. I definitely never jump in when the market first opens because it's too volatile for me. I just wait on the sidelines for 10 to 15 minutes before I jump in any stock, right? So I wait, I wait, I wait, I wait. Then I see my doji stick. I see my doji spinning top, right? I love this candlestick. It tells me that there's about to be a reversal up, right? So look, I'm thinking about jumping in. But the moment I jump in is when right here, I see the buyers has increased and the RSI is telling me is gaining strength in an upward trend, right? It's gaining strength in an upward trend. So I jump in right here. I see it's gaining strength in an upward trend, right? It just now crossed VWAP. It also crossed over on the MACD. The buyers has increased. So I jump in about right here. Boom. And I ride the roller coaster. I ride it up, ride the roller coaster up. It touches the band. So now it touches the band. Now, as these touch the band, I'm starting to be very cautious of what happens next. Like I'm very alert on what's going to happen next. Why? Because I know usually when it touches the band, it's going to come back down, right? Because this is like a point of resistance for the stock right here. I know that at moment soon as it touches these Bollinger Bands right here, the north deviation band. I know as soon as it touches this, it's probably going to come back down because this is like a point of resistance for the stock. All right, so I'm watching. Well, what are my charts doing? Okay, buying pressure has cooled off, right? RSI is going downward, right? And now it's trending towards down. It's trending towards VWAP. It's trending towards. So I'm watching, trending towards VWAP, the average price of VWAP, right? But I don't punch out until it actually crosses VWAP. And then I see it cross over here. And then all of a sudden, no more buyers are in. It's turning into a seller's market, a bear market, right? It's time to punch out, right? So I punch out probably in the middle. I lose a little profit because I wanted to see, make sure I didn't go back up. I'm gonna lose a little profit, but I'm okay with losing a little bit because I want to make sure it doesn't keep running. So I punch out about right here, right? And then watch it for a second, you watch it ride down. Okay, boom. Boom, it's still riding down. Let me go check out a couple of other stocks real quick while it's riding down. Let me go look at my other screen and check out some more stocks. Oh, boom. Okay. Now I see the stock. Oh, it has gotten to a point to where the stock is now oversold. Too many people are oversold. So since the stock is oversold, right? And then now it's touching the south Bollinger Band, right? The bottom Bollinger Band. So I know as soon as it touches the bottom, it's usually going to run back up. So it's being oversold, right? RSI is telling me the sellers are still got control of the game, right? But it's also telling me that the sellers are starting to lose pressure, right? Are starting to lose trend. They're starting to lose depth. So guess what? I'm watching it. Boom. I'm watching it. And then I watch it to right here. Okay. Then I see what happens. The MACD crosses over. Buyers are now in control. So I jump in, right? Because it crosses over. Buyers are in control. It's going upward towards VWAP. It touch and it goes over the medium, right? So I jump in, ride it, ride it, ride it. Just stay basically flat. Didn't do much of nothing, right? Didn't do much of anything, right? Then boom, boom, look. Then I watch it cross over. Look, it crosses over. MACD crosses over. Buying pressure is going down, right? Buying pressure is decreasing. And this is becoming a seller's market again. And it crosses over on MACD and it touches the bottom. All the wind is going out of the stock. So it's time to move on to something else because it shows me, look, the stock is going to stay flat. It's not trending anywhere. It's going to stay flat. The lines contracted, right? So it lets me know all the volatility is going out of stock. So it's not volatile anymore. So it's not going to make any big moves up or big moves down enough to make me enough money to continue to play with it. So guess what? We stop playing with this stock, right? Because at the end of the day, the whole goal is to make money, whether you're making money from the stock going up or from the stock going down. But again, these Bollinger Bands always help us to trade the gap. Helps me to know when to jump in. So when all three say jump in, so when the Bollinger Band says jump in, the VWAP says jump in, the MACD says jump in, the RSI says jump in, I'm in. I'm in because that I know 100% unequivocally, without a doubt, that the stock is going up because all my indicators say so. That's why you need multiple indicators because one indicator by itself cannot help you predict the uh, future price of how stock is going to move, right? The only way to predict it is have multiple things helping you to forecast the stock's future price. But you need again all of these things. And I hope you have learned a lot from these indicators. These are something I use every day. Matter of fact, you can always email me at info at yourwealthywallet.com, and your wealthy wallet is spelled with UR, wealthywallet.com. If you have any questions, you can always contact me there. I thank y'all so much. If you like what you've heard today, please subscribe, like, or follow and comment, please, or even put in the comments if you're on Instagram or Facebook listening to this. I mean, we answer all questions, and we don't mind throwing coaching sessions. We just here to teach, man, and help people make money. So again, thank you for joining Your Wealthy Wallet Wall Street course, and I'll see y'all again next week as we do it all over again. Thank you.